finish off with seg funds now. So continuing on now, looking at some of, so we know what they are, we know how they work, we know some of the great advantages of them. So now let's look at the different types of seg funds and finish off with some of the limitations to them. All right, so starting off with the different types of seg funds, which I have here on this side. So first one we're going to be looking at is money market funds. And like I said earlier, these are your lowest risk funds. And the problem with when you have a low risk, the good thing is that you have a low risk, but the problem is they also give a low return, right? So that's why they're able to give that low risk. So lowest risk and lowest return as well. And then when we also with money market funds, they usually have about 95% of their assets in cash or cash equivalent types of investments, which is why they are able to give that low risk and low return. It's usually treasury bills or government of Canada, those types of investments, government of Canada bonds. The second type of seg fund investment you can do is called bond funds, and these are the fixed income type of funds that we see. And they usually have a certain percentage that is in fixed income securities. So definitely a very safe investment. And again, because it is more of a safer investment, again, not the greatest return again. Moving on now, as we get into the little bit more risky side, we see equity funds. Now, these are known as your growth funds, right? This is where majority of the growth does take place. And because of that, obviously, it has a higher levels of risk that's associated with them as well. So depending on the type of investor and what they're looking for, compared to the other types of funds, definitely a much higher type of risk that we see. And where do they invest? They usually invest in stocks of publicly traded companies. And that's why they're able to sort of provide that type of growth as well. Next one is income funds. These are the funds that pay, they're based on the stability of bonds, and they usually pay a regular interest as well. And they do have that possibility for capital appreciation as well. And they're, again, one of the lower risk type of funds as well. The next one we have, and this is a very popular one for exams as well, they're called balanced funds. So if you notice with these ones, either it's low risk or it's high risk, low return or high return, depending on the type of investor you have, what they're looking for, and what they're hoping to get out of. But what if someone is kind of in the middle, right? They want some growth, but they don't want to take on such a high risk. So, they've been exposed to some sort of investments, but at the same time, they don't want to take on such a big risk with their money. So this is where balanced funds is perfect for that individual. So what they do is they invest in both stocks and bonds. So they have some funds that are going here in the higher investments, and some funds that are going here in sort of the lower risk categories as well. So it's giving a balance. So not all of the money is exposed to so much risk, and yet not all of the money is put in a place where the growth is going to be, so stagnating and so slow as well. Right, so this is a great type of fund to invest in, and like I said, very, very common and very likely to come up on for exams as well, right? So it's for that person who has some exposure to investing and is looking for some growth as well. All right, and also the last one here that we're going to be looking at is real estate funds. Now, real estate funds, one of the key things we have to remember is that is illiquid investment, and if you remember from our previous segments, that means that you can't get your money out right away. You may, but you may not as well, because sometimes you've seen real estate properties might be on the market for months, maybe years, maybe not years, but months, right? So if somebody needs cash fast, or they need their investment access really quickly, they might be stuck if it's all in real estate funds. That's not to say that they're always bad, right? We can't eliminate them and say, okay, don't invest in real estate, your money will be stuck. So it depends on the person. If they have some investments in other places where they're able to get their money out when they need it, they have some money put away for emergency fund, they can definitely go ahead and invest in real estate funds because they have other sources of drawing those funds if needed. The only time when it would not be advised is to put everything in here and you don't have anything for emergency fund or anywhere else to draw money from. So it should not be that majority of the money is here and that's where you're waiting to take the money out of if needed, right? So we always want to, again, diversify the funds. Right, so these are all the different types of funds. Now, depending on the investor, what they're looking for, what kind of investor portfolio they have, they can be investing in different types of funds as well. Now, finishing off this segment with looking at some of the risks and limitations that we see with seg funds. Although a great product, a lot of benefits, a lot of advantages, we always want to cover those disadvantages or those limitations as well. So one of the limitations is that there is a risk to capital. Now, what do we mean? We said that there is no risk to capital because we said, it could be 100% guaranteed. Yes, but remember when I told you guys that there might be a guarantee of 75%? That's when you see a risk to capital. So your 25% is still exposed. It's not a great limitation, and it's not a big, something that might draw people off really quickly. But it's still a limitation, right? So if somebody's investing $100,000 and the guarantee is 75%, there's still a $25,000 loss that they can potentially have to face if that happens. So there is some risk. If the guarantee is 100%, then there's no risk, okay? There are sales charges. So there's a FEL sales charge, which is a front-end load, or the deferred sales charge, a DSC. Now, if you remember, when we talked about some of the advantages, we talked about the fact that there is professional management. So there's somebody who is managing your money. Now, when you're hiring somebody for a service, obviously they have to be compensated, right? So this is where some of the limitations or the disadvantages of seg funds come, is that there are charges for those sort of services that you receive. There's a management expense charge, right? So you are paying for that, for the compensation of those professional money managers. That's coming out as well out of your pocket. There are penalties. You are able to withdraw if needed, but however, the guarantee only applies if you hold it in for the full 10 years, a maturity guarantee. What if you need to access your money a year after you put it in? You can take it out. You do have that ability, but however, there might be penalties you may have to pay for taking the money out so quickly, right? So depending on how long it's in the fund, those penalties might be, more or less, but there are penalties. And there's also age restrictions. Now, not for everything, but for certain types of, investments that you might want to do. For example, if somebody wants to invest in RRSP, it has a 71 age restriction, right? So you cannot add in more money. Deposits cannot be made until after the person is 71 years old. So there are restrictions of that as well. So if somebody wants to keep putting money in, they can't put it in this product. There are other products that they can, but they won't be able to put it specifically in this product. All right, so those are how seg funds work. So we went over a lot in these two modules. Go back and watch them again. I definitely try to condense as much as I can. So we went over what they were, how they work, advantages, disadvantages, different types. So everything that you pretty much need to know. Now in the next segment, we'll do the same thing with annuities. So look at what they are, how they work, what are their advantages and disadvantages. All right, so I'll see you all in the next segment.